Hey, it's Anthony and Tucker with Land Title. We came to bring you your Boulder County market update for the month. Let's dive right into it. Tucker, what's happening in the detached market?
So first off, detached and attached are acting completely different right now. So if you have a buyer or a seller asking, hey, I'm bringing a property on, I'm looking to go buy a house, ask detached or attached. Because if they're in the detached or attached, it's going to be a very different market, very different feeling for the two of them. So first off, just looking at our high level active listings, we are up month over month. That's normal. We expect that in our spring season. What's surprising and what's good for those with listings right now, or one of the silver linings, let's correct myself, is that we're just under 12% down year over year on our number of active listings. So even though our buyer demand is suppressed, we're not having this surge of inventory and active listings on the market, which is a good sign for those who are already on the market.
If we go over to the attached side of the market, it's a little bit of a flip side, but it's really based off of the area, right? I mean, realistically, inventory is up about 2% year over year. We have almost 500 active attached dwellings on the market, and over half of them are in the city of Boulder. So there's a lot sitting here in the city of Boulder, but it's basically where it was a year ago. I mean, that's kind of the other thing is we've been at this elevated level for a long time, and we're seeing another year again of rapid growth, very different from the detached market.
Yep, but when we look at our detached market, things are looking a lot better than the attached market. So let's really focus on this. So looking at our month supply of inventory, I just really want to stress the county as a whole is at 3. Outside of Boulder and Niwot, everyone is 2 and under. So that really leans towards more of a, quote, buyer favored. Now we know with the concessions out there and the current interest rate environment, it's not exactly 100% buyer favored, but it is still leaning that way. But it's not as strong as it would be in certain areas like Boulder, which is leaning much more further buyer favored. So even though they're under that 2-month supply of inventory, which is normally meaning buyer favored, what this is really knowing, and in this market and knowing these stats in our anecdotal conversations, is that it's much more level footing for that median or even median plus, median minus kind of price band for those homes. And looking at that month supply of inventory, it just shows how much of affordability is a big picture, which we'll talk about further.
Absolutely. And in the attached market, you're almost on the complete flip side of the coin. Superior is sitting at the high at 7 months. You got the city of Boulder pushing 6 months of inventory. As a whole, this entire market is really just climbing in the amount of supply because there's just not as many buyers out there gobbling it up, right? But even out in the L towns and Erie, you're talking 4 months of inventory. I mean, this is a drastically different market than under 2, right? You see in detached.
Yep, and this is why we see our days in MLS for our detached getting all the way down to 32, right? We've come down off such a high over the last, 4 or 6 months, especially in those winter months where we're sitting elevated. We're down to 32 days. Now, does that mean every house? No, but the ones that are ready to go, your listings that are dialed in, they're appropriate for the price point, they're move-in ready for that price point, those are moving quick. Whereas some of the ones that are sitting longer, they're just not move-in ready, need updates, things of that nature. But then as we're looking through our numbers, just want to focus again on Louisville, and their shortage of supply continues to just keep that market so strong, so stable, and anything that is even within reason in that market is getting offers on it and getting moved up. And that's why their days in MLS is so low, is they have such a limited supply.
They do. Now, if we look at the attached side of this, instead of going from that 30 days, we're going to 55 days. And honestly, not a lot is selling. So when you see a market like Superior show 3 days, it might be the only product that sold that month. Now, that says a lot. But if you get out to some places like Boulder with that huge elevated inventory level, or Longmont, they're around 60, and that's keeping that average probably a little bit more appropriate for what it should be right now, especially with so much inventory. It still is the same situation, right? If you have a great product in a great location and it's buttoned up, but it still has to be priced right, it can move. It's just still going to take a little bit longer.
It's just your pricing conversation attached is going to be a lot more difficult.
It is. All right, so Tucker, what about by price range? Because this is a hugely different conversation too.
Absolutely. And so we'll see the function of cost here in a little bit, but just let's start at the top and just look at our 3+ million. What is luxury doing? Well, we don't have the exact information and no one does, but it feels like a lot of those listings that are sitting right on that cusp of 3 million, have come down into that under 3 million to that 2.5 to 3 million. So we've seen really strong sales activity there year to date. We've seen it good, month over month, up and down. It's always luxury. It just depends on who decides to buy that month. But really, we've seen some good activity in that, really from $2 to $3 million range, from that $3+ million range listings coming down in price and now going under contract and getting sold. While on the flip side, listing wise, yeah, we're at 142 listings over $3+ million.
It's a lot.
And we had 4 sold. It is a buyer's market, but that is luxury real estate. It's just going to take time. Where if your sellers are in a pinch or need to move, that's another conversation. This would be a great graph to show them. Now, as we get into more of the meats and potatoes of the market, I really like looking at this under $1 million mark. And what we really see is strong sales activity in this market. And we can kind of see that, under $1 million, really when we get into that under 800,000, it starts increasing based on where the supply is. And so I really want to focus on that our sales are doing quite well in our median to sub-median, even median plus when it's in the city of Boulder. It's really where we're seeing the, kind of the slowdown is, or, properties not selling as fast for the value they are hoping, is once we get over that $1.5 million mark in the county, or excuse me, about 1.2, I'd say honestly, but 1.5 from the stats. And then really that's where we kind of see a little bit more of an adjustment is once we get over that $1.5 million mark.
Now, the attached side of the market, honestly, I think part of the reason detached luxury is doing so well is people have really made a change in the last year to where they're actually buying more detached than attached luxury. Before it was like, you want a cool move-in ready place. It's in an awesome location. They'll totally pay a premium, buy a townhouse at $1.7 million. Well, we've really seen a little bit of that shift this year. And so, we've actually only had 4 total sales over $1.5 million actually take place for the year. And it's really slow. But here's the other side of it is the first-time home buyers are coming back a little bit to this market, right? Under 600,000, think 4 to 600,000 range, townhouses out in the county, maybe some decent product here in the city of Boulder. That really is just slightly better. Now, granted, this is sold activity in April, so we're comparing first 3 months of under contracts. I do think you're going to see this swing again back the other way. And with Sundance coming to town, I don't see luxury having a huge long-term issue here either. But we are seeing some minor changes, but it is truly bedrock, right? I mean, you got 100 listings on the market from 3 to 400,000 and only 20 sold.
Yeah.
So, and that's pretty much the way that it's felt across attached for most price ranges the entire time.
It really has. And so when we're looking at our detached, this is going to look a lot better because what I see on this left-hand graph, this month supply of inventory, if we all remember our high school math, it's a function of cost. So as cost goes up, month supply of inventory also goes up because there's just less buyers in that market. So that's what I mean by a function of cost. So as we're looking at this, really all the way up to that $1.5 million, we're at 2.5 months and under for the most part, which is right. Historically, we'd say, Yahoo! That is a seller's market to balance market kind of number.
And they're moving fast, which is awesome.
And they're moving fast. But that's also because so many sellers have become more adept to offering the concessions, understanding I'll list at my number, knowing there's a 20 or 15 or however much concession coming in. So that's a really good sign that we're seeing the prices land there. Now, when we're looking at a month supply of inventory, I just can't stress enough how much of it is based on cost. So really, your listing, when you're looking at it and you're looking at these graphs, hey, I'm under 1.5 million. Okay, I can give my seller different expectations than I can at that 1.5 to 2, let alone that 2 to 3, and then that 3 plus. That 3 plus, make sure you're getting a 12, if not 18 month, if not 24 month listing agreement, because it's going to take that long to sell it.
24 months of inventory is a lot.
And I hate to say that, but push for those longer listing contracts so then you're not out marketing and getting fleeced when 12 months is up or 6 months is up and you're having to renegotiate on that $3+ million listing. Warn them this is a marathon, not a sprint.
On the attached side, it's kind of the opposite side of the coin. The good stuff really still is selling fairly rapidly. We're talking 45 to 55 days, but it truly has to be buttoned up, dialed in, great location, the whole bit, and at the right price. But the rest of the market, I mean, we're talking 5.5, 6 months of inventory, everything under $1.5 million. The luxury market looks a lot like the detached luxury market. There's a lot of inventory. Buyers can absolutely go out there and make offers. But the difference is, even the lower price stuff, buyers should be out there. They should be aggressive. They should be making offers. They can absolutely go get stuff under contract. And there's definitely opportunity to be had in the attached market across all price bands.
There's a ton of opportunity in the attached market. The question is, have we hit the bottom? And if we haven't hit it, where is it? And when do we start bouncing off of it? Without this current geopolitical, war and all this stuff going on with rates and how that's impacting us, I really thought this was going to be our year, and the numbers were supporting it for attached. But it just shows how interest rate sensitive attached is, even compared to detached.
Exactly.
So just keep that in mind, where your listing price should really just be based on where the mortgage rate numbers are of that day.
Okay, so with all that said, let's talk a little bit about trailing 12-month data. This is the best way to have a conversation about where's the real estate market going? Like, what are prices doing, right? And Tucker, tell them about detached.
So
this is important.
This is super important. And so when we look at the trailing 12 months, and in the graph, that's that TTM change percent number, trailing 12 months. We're comparing the previous 13 to 24 months to the last 1 to 12 months. And just seeing an average of averages where price is moving. And what we're really seeing is that, for the most part, a lot of our county has had a decrease over the last 2 years. And that is what we kind of expect. When rates go up, prices come down. It is, unfortunately, a very elastic, relationship.
It is.
It means if one moves, the other one moves. Elastic, right?
Yep.
They move, one moves, the other moves. Sorry, a little too economic. But then where we see some nice growth in our detached market in prices is the areas that are a little bit more affordable. So we're seeing it in our Superior, Erie, and Louisville. Those are areas that are hot either in location or hot on price, because buyers are not just shopping on price right now. On location. They're shopping on price and location. So price and location are now getting factored in. And these stats really show that, hey, it's not just location anymore. It's also price. And I really just can't hammer that home hard enough, because we see places like Longmont and Boulder, which are acting different than the rest of the county because their prices are a little bit more elevated respective to the product type.
The attached market has seen a significant change, more so than the detached market. So when you look at a place like, Lafayette is a really good example. Minus 8% in the last year drop, and that's a lot of townhouses and stuff. The Boulder County market, or the city of Boulder market, down about 8% as well. The places that have favored the best, Superior's favored really well. It could largely be due to new products, luxury stuff, rebuilds from the Marshall fires. There's a lot that kind of goes into that. And the most stable market of the bunch is Erie at flat, but it honestly favored pretty well. Yeah. So that's a good sign. For everything being considered here, I think Boulder is in a market that's fairly stable, right? Yeah. We've definitely seen some volatility over the last 4 years as this market has settled a little bit, but it's pretty stable here.
It is stable, and what's leading to that stability is if we're looking at our percent sold to list price, and this is really based on the final sales price in the MLS, final list price in the MLS to what it actually got sold at, and we're seeing they're coming in at 98, 99%. Which you might go, wait, that doesn't make sense, Tucker and Anthony. Why is that? Well, it's because the concessions aren't included in this. And so what we're seeing is folks are pricing their homes with a concession plan for. And I cannot recommend that enough, because the data is showing majority of homes under $1 million, over half are getting a concession. So what does that mean? That really means that when you're pricing that detached home, plan that pricing in. Talk to your lender partners and know what the point buy down would be on a standard loan. And then how to list it accordingly and have that conversation up front with your sellers. So I really think that's some value you can take is, hey, if we plan for a concession, we're going to land pretty close to the number we're listing at, but that's with us planning for a concession.
Absolutely.
Now attached, that's...
Honestly, attached
give it away. No, I'm joking. I'm
give it
joking.
away.
I'm joking.
Now, here's the data. You can see this in attached, but it's very similar to what you're seeing in detached. The reason that it's not showing so much worse, especially with the price drops, is the price drops are not factored into this equation. So this doesn't actually tell us a whole ton about it. What I can tell you is the attached market, according to this chart, is favoring slightly worse than it was a year ago, where the detached market is favoring slightly better than it was a year ago. That's all there is to it. So don't forget to reach out to Tucker and I if you need data, have questions, concerns, anything like that. We're just here as a resource for you. That's why we do this. So thanks for joining us today, and we'll catch you next time.
Look forward to it. Thanks, everybody.